most of the crypto people I speak to expect a 4-year cycle, and they're adamant, that maybe Bitcoin peaks early next year. But as you know, when something is so strongly held, it's very unlikely to be true. So either Bitcoin's already peaked or we have a longer cycle. I'm more in the camp that it's a longer cycle.
But there would still be 50+% drawdowns in the future?
I'm sure there'll be 50% drawdowns because the stock market has more frequent 25% drawdowns.
Mm-hmm.
I mean, that's when, even though people realize, the stock market's made a lot of progress last 6 years.
Mm-hmm. We've
had an unusually large number of 25% drawdowns.
Mm-hmm.
And we probably have another S&P decline of 20% next year. So if the S&P is down 20, Bitcoin could be down 40.
The idea of a 4-year Bitcoin cycle, once treated as gospel, is starting to unravel. In previous bull markets, Bitcoin's price action seemed neatly tied to its halving schedule, peaking roughly 12 to 18 months after each event before falling into a brutal bear market. But 2025 is proving different. Despite widespread expectations for a repeat of this pattern, Bitcoin's resilience in the face of macro headwinds, combined with deep institutional involvement, suggests the cycle is elongating. Analysts like Tom Lee of Fundstrat and Raoul Pal of Real Vision both argue that this time, the relationship between liquidity, technology adoption, and investor participation has fundamentally changed. Instead of predictable boom and bust patterns, we may now be witnessing a more complex and longer expansion phase, where Bitcoin tracks global liquidity more closely than the halving calendar. This new dynamic makes sense when viewed through the macro lens. Global liquidity has been rising since mid-2023, and central banks, despite rhetoric about restraint, continue to inject balance sheet support through various mechanisms. According to Raoul Pal's Global Liquidity Index, risk assets like Bitcoin, Ethereum, and the Nasdaq have been moving almost in lockstep with liquidity flows. Historically, these waves tend to produce sustained uptrends punctuated by sharp but temporary drawdowns. That's exactly what Lee anticipates: 20 to 40% corrections as part of a larger bullish structure. His message is clear: volatility isn't a sign of weakness anymore. It's the new rhythm of a maturing market adapting to institutional participation. Lee's thesis also draws strength from recent behavior in traditional markets. The S&P 500 has endured multiple 25% pullbacks over the past 6 years, and yet remains in a long-term uptrend. If equities can correct deeply and still make new highs, there's no reason Bitcoin, a higher beta asset, can't do the same. What's more, Lee notes that correlations between Bitcoin and gold have begun tightening again, implying that monetary hedges are back in favor. Gold's powerful breakout since July may, in fact, be signaling what's next for crypto. As liquidity rotates through hard assets, gold tends to move first, and Bitcoin usually follows. In his latest discussion with Anthony Pompliano, Lee connects gold's breakout to stablecoin dynamics and explains why it could propel Bitcoin toward $200,000 by year-end. Then he turns to Ethereum, outlining why he believes it's entering a supercycle akin to Wall Street's transformation in the 1970s. So stay tuned, hit that like button, subscribe if you haven't already, and let's get into Lee's full analysis of where Bitcoin and Ethereum could be headed next.
There's a lot of reasons gold probably is going up. And at Fundstrat, we don't do commodities. I kind of regret not recommending gold because it's been so great. Because, generally, I like to be helping our clients be involved with things that are going up. So I think gold's move is like
a good strategy.
Yeah, exactly. I don't want to fight it. And
what kind of business do you have? I help our clients' portfolios go up.
Yeah. So gold's been amazing. I think what's really stood out is that you can explain gold's move by just pure technicals. Like I was talking to our technician, Mark Newton, yesterday, and he says that gold had a cup and handle pattern that the breakout was July of this year. Mm-hmm. And so the measured move should have taken it up to where it is now. But let's say price leads fundamentals. I think that July is also the time that the stablecoin industry started printing a lot more creations. And as you know, there's been gold stablecoins and dollar-based stablecoins, but a lot of the dollar-based stablecoin issuers are over-collateralized. Mm-hmm. So I think the stablecoin industry has been printing a lot of dollars. They're over collateralized. And I think they've been buying a lot of gold. So I think that the stablecoin industry has been the newest bid for gold.
More so than even like a China central bank?
Yeah, because they've already been present. The central banks have been present for some time, but there's somebody new buying gold on top of the retail buying gold. And I think that would be my guess. Because, like I've now there's like 7 or 8 gold stable coins. Plus, there's big stable coin issuers. And so that could be the bid to gold. Now, does that mean gold is unlimited on the upside? I don't know. I mean, I'm not studying it, so I don't know. But I think it's very bullish for Bitcoin and Ethereum because...
Why?
Well, gold moves first and then Bitcoin catches up. So I think that there is going to be the network value of gold just went up by a lot. And so let's say gold settles at 5,000. That puts fair value of Bitcoin, like 1.6 to 2 million if it matches gold's network value. So I think it's actually helping Bitcoin's future terminal price.
So you think that if gold settles at 5,000, Bitcoin, if you take the gold market cap divided by the number of Bitcoin, then you get $1.6 to $2 million per coin. What's the time frame for us to get there?
Well, I can see that in 5 years for Bitcoin. So I think
5 years.
Yeah. Yeah, I think
That'd
Bitcoin. Yeah, I think Bitcoin doesn't get capped by gold. It actually gets pulled up by gold.
Do you think that on December 31st of 2025, we'll actually look back and could Bitcoin have outperformed gold in 2025, even though it has such a big lead right now?
Yeah, I mean, we have a lot of time. We have 10 weeks. As you know, Bitcoin makes its move in 10 days a year. So are Bitcoin's best days in the fourth quarter? Probably, because we have catalysts, the Fed's easing. We have a shutdown that's been risk off. We have China-US tensions that, look, every time there's a headline on China, like Bitcoin takes a gut punch, right? Because it is money flows and deleveraging. So that goes away. We have seasonality that favors stocks moving up. Stocks moving helps Bitcoin. So to me, the chances of Bitcoin having a huge fourth quarter are really high. And not all of these would be tailwinds for gold. So I wouldn't count. I still think it's possible for Bitcoin to hit 200,000 by the end of the year.
And what about the 4-year cycle? Do you think that holds, or do you think that was something that was broken by the institutional participation in the ETFs? Well,
most of the crypto people I speak to expect a 4-year cycle. And they're adamant, that maybe Bitcoin peaks early next year. But as you know, when something is so strongly held, it's very unlikely to be true. So either Bitcoin's already peaked or we have a longer cycle. I'm more in the camp that it's a longer cycle.
But there would still be 50+% drawdowns in the future, or there's a kind of cycle is broken and something different?
Yeah, I'm sure there'll be 50% drawdowns because the stock market has more frequent 25% drawdowns. I mean, that's when, even though people realize, the stock market's made a lot of progress last 6 years. We've had an unusually large number of 25% drawdowns. And we probably have another S&P decline of 20% next year. So if the S&P is down 20, Bitcoin could be down 40.
This stock rally, you've called it the most hated rally. The recent sell-off because of Trump's tweet, you called a flesh wound. You're like uber bullish. I am as well, so I'm biased. But why do you think it's so hated? Why do these people want the market to go down? Why do they want the U.S. economy to tank?
Yeah, I can empirically show it's the most hated. One of the best measures of large investor sentiment is the AAII Net Bulls Index, bulls less bears, because it's been run for 40 years. This year, it's averaged minus 11.7. So every week, the weeks through this year. There's only 3 other times in the last 40 years it's registered negative 11.7. 1990 or more, 1990, 2008, and 2022. All were bear market years. So sentiment reads as if we're in a bear market and the market's up 15% year to date. Why is it the most hated? I think we show this in our research that it's based on political divide. So the country is 50-50 Republican Democratic. But in the stock market world, and there's Pew Research data on this, 57% of professional money managers are Democratic. 66% of hedge funds are Democratic, and something like 69% of venture capital funds are Democratic.
Interesting.
So the risk capital world didn't vote for Trump. So they view his policies as that of someone who is destabilizing to the economy. In the bond market, it flips. 80% of credit managers are Republican. So that's why this year the bond market hasn't been, high yield spreads have been stable, credit spreads have been stable, but the stock market's been volatile. And you can see it maybe in the economic commentary this year. How many economists have said, oh, tariffs are going to cause a recession, or tariffs are going to cause an inflation surge? That is actually a very subjective argument, because tariffs are a tax. And if we treat it as a tax, taxes are not inflationary. So we never say it's inflationary. But the economists who are portraying it as inflation are, I think they're taking a specific view that makes it an inflation argument. So in other words, there's some sort of bias in that statement.
What's fascinating about Lee's reasoning is how he ties technicals, liquidity, and structural demand into a single thesis. He attributes gold's breakout not just to macro fear or interest rate shifts, but to stablecoin collateral flows, an angle few others have considered. Over-collateralized stablecoin issuers, many of which hold real-world assets, may now be adding gold to their balance sheets, providing a steady bid under the market. That same bid, Lee argues, eventually spills into Bitcoin as gold's network value expands and digital assets begin to reprice against it. If gold stabilizes near $5,000 an ounce, Bitcoin's fair value, based on network parity, could land between $1.6 and $2 million per coin. Lee doesn't claim it'll happen overnight. His horizon is about 5 years, but he insists the direction is clear. The growth in gold's monetary base will inevitably drag Bitcoin higher as institutions treat both assets as complementary stores of value. But Lee's bullishness doesn't stop with Bitcoin. His discussion of Ethereum reveals something much larger at play, a structural transformation similar to the one that reshaped global finance after 1971. When the US left the gold standard, Wall Street had to reinvent the financial system, creating futures, money markets, and a massive synthetic dollar ecosystem. Today, Lee believes Ethereum is having its 1971 moment. With the rise of stablecoins and tokenization, Wall Street is migrating its infrastructure onto public blockchains, and 70% of that activity is happening on Ethereum. Through this lens, BitMine's strategy of using Ethereum as a treasury reserve and staking asset isn't speculative. It's a modern reflection of how corporations once adopted the dollar as a reserve currency. As Ethereum's staking economy matures and institutional players like BlackRock and Goldman begin tokenizing assets, Lee sees Ethereum's value soaring in tandem with this new financial architecture.
BitMine on Monday announced that we're at 3.23 million Ethereum.
So we're 50% of the way there.
Yeah, 2.7% of the Ethereum supply.
Okay. What is the purpose of the business? Just tell us a little bit about it.
Well, BitMine is an Ethereum, primary strategy is an Ethereum as the treasury asset. It still has a small Bitcoin mining business as its operating business, but now its primary treasury asset is Ethereum. And the reason it makes sense to grow the Ethereum holdings is that Ethereum as a smart contract platform with staking means that large holders of Ethereum can benefit from the power law dynamics, meaning you can be a benevolent entity in the community helping see DeFi, and also as payment rails get built on Ethereum, help guide that process. And so we're working with the Ethereum Foundation. Today, BitMine's 3.23 million Ethereum tokens makes it the largest holder of Ethereum in the world, more than the Ethereum Foundation, more than any other single holder. When we begin our staking, native staking, that's about a 3% yield on roughly 14 billion worth of ETH, and that's nearly 500 million of pre-tax income. That would make BitMine one of the 800 most profitable companies in America. So it's basically going to be a Russell 1000 company. And for institutional investors, they've put a big allocation into MicroStrategy because that is the way that they get exposure to Bitcoin. But Ethereum, we've been writing about, is probably in a super cycle, similar to what happened to Wall Street in 1971. Because in 1971, the US withdrew from the gold standard. So the dollar became actually synthetic, completely synthetic.
Mm-hmm.
So Wall Street stepped in to make sure the dollar stayed the reserve currency. So they built futures, CDs, money markets, and it succeeded because within 10 years, even though the dollar was only 27% of GDP, it became 53% of central bank reserves and 80% of all financial market quotes. So the yen didn't win, the Deutschmark didn't win, or the French franc. In 2025, we're tokenizing more than just the dollar. The stable coin is the breakout product, which is a tokenized dollar. But as you know, Larry Fink, Robinhood, they want to tokenize everything on the blockchain, and they're going to build it on a neutral public chain, which is right now, 70% of that is happening on Ethereum. So Ethereum is experiencing that same 1971 moment where Wall Street's rebuilding everything onto a blockchain, which we think it'll be Ethereum. Ethereum could recover its Bitcoin Ethereum ratios, 2021 highs. That would put Ethereum at around 21,000 per token. So it's I think an undervalued asset. And by acquiring more and staking it, we benefit from the power law. And so it's been successful so far. Bitmine is the 30th most traded stock in America today, trading $2.1 billion a day. And it benefits from, I think, our clear communication. We publish a monthly chairman's message that explains our thesis around why Ethereum is in a super cycle and why Bitmine is continuing to acquire and stake its Ethereum.
To the Bitcoiners who say all of the altcoins are not valuable, how do you kind of talk through with them why they're wrong?
I'm a Bitcoiner myself. I think Bitcoin, and we explain this in our presentation, is digital gold. So it's storing value, and it stores value and it moves value exceptionally well. Bitcoin is really sound money. I'm a believer in that. But Wall Street is going to be building products and tokenizing products. They're not going to be building on the Bitcoin blockchain. Because they need a smart contract platform. Mm-hmm. And as you know, if you look at whether Solana or Ethereum, if you look at the total value locked, about a third of that value, gross value, becomes the intrinsic value of the chain. Like that's been the floor for Solana and Ethereum. Mm-hmm. The global economy is 80 trillion, but it's understating because, GDP is a final sales concept. So let's say it's 120 trillion. You can't put 120 trillion onto one public chain because this Ethereum would be like, $20 million because there's just so much value locked up on it. So there's going to be room for more than one L1. But Ethereum has been the place that's been capturing more than 2/3 of all the creations. It's had 100% uptime. But almost every project that's been announced is a layer 2 on Ethereum. So I'm not against Solana or Avalanche or these other chains, but as an institutional grade blockchain, Wall Street's building it on Ethereum. I think crypto really has forced us to rethink what I call rent seeking really looks like. Because Bitcoin, the community is capturing the value. That's why the Bitcoin blockchain grows in value, is because it's all the energy required is reflected in the price. In smart contracts, I think it's proving that it's a fat protocol. So instead of TCP/IP being the base layer for Ethereum, whatever you're staking and operating on Ethereum, the value is captured on the blockchain itself. It's acting as a monetary base. So to me, the price of Ethereum probably goes up a lot in the future because, just as a simple mechanical measure, if BlackRock and Goldman launch stable coins and they have tokenized stocks and it's an L2, but it runs on Ethereum's L1, they'll want to care how the L1 upgrades. So they're going to eventually own Ethereum. Mm-hmm. So then if 20 investment banks buy Ethereum as a balance sheet reserve, as much as they hold Bitcoin as a reserve, then the price of Ethereum is going to go up a lot.
If Lee is right, we're entering a phase where Bitcoin and Ethereum play complementary roles. Bitcoin as the base layer of digital sound money, and Ethereum as the programmable foundation for tokenized capital markets. The old halving-based cycle is giving way to a new paradigm defined by liquidity flows, institutional demand, and macro adaptation. Ethereum, in particular, stands to benefit from network effects that compound with every new tokenized asset or stablecoin issued on its chain. As staking yields attract traditional investors and balance sheet allocations increase, the price appreciation could become self-reinforcing. Lee's call for Ethereum to reach $21,000 may sound aggressive, but given how far tokenization has already progressed, from US treasuries to corporate bonds, it may actually prove conservative. This convergence of macro liquidity, institutional adoption, and blockchain innovation paints a powerful picture for 2025 and beyond. Gold is rising, stablecoins are expanding, Bitcoin's drawdowns are healthy rather than fatal, and Ethereum's architecture is becoming the backbone of the next financial system. Tom Lee's optimism is grounded not in hype, but in pattern recognition. He's seen this playbook before, from the post-gold standard boom to the digital transformation of markets. If his analysis holds, we're still early in a multi-year liquidity-driven bull cycle that could redefine global asset allocation. Thanks for watching. If you found this analysis insightful, don't forget to like this video, subscribe to the channel, and let me know in the comments where you see Bitcoin and Ethereum heading next. Your engagement helps us bring more expert-driven insights like these straight to you.